Hey everyone, me Kevin here. If you're a homeowner, there are three important things that you should do. First, as a preface, and this isn't like another market crash video, but let's be real. Home prices have already started falling, nationally by about 5.5%, and we expect them to continue to fall. It's likely that home prices will fall anywhere between 15 and potentially as much as 30% over the next 2 years. Now, that doesn't necessarily mean rush to the exits and sell, but it does mean that we should be prepared for home values to continue to fall. And all of it is going to be predicated on how aggressive the Federal Reserve is with raising interest rates. The more the Fed raises the federal funds rate, the more the Treasury market prices in a higher yield for bonds. Now, the reason I say that is because bottom line, you could use a little trick to understand what direction mortgage rates are likely going to go. And what you do is you just go to Google, very simply pop on over to Google. Here you go, we'll grab a little browser here and just type in 10-year Treasury CNBC. For example, simple. You type this in, and anytime this goes up, you want to expect that interest rates for mortgages are going to go up as well. Anytime this is above about a 2.75, we tend to see permanent damage to the real estate market in terms of pricing. Given that right now we're sitting at almost 3.8%, we know the longer we sit here, the more pain we get. And the more aggressive the Fed is, the more this chart is likely to go up, and the more quickly this chart is likely to go up. Even Federal Reserve board member this morning, Susan Collins, mentioned this morning that she expects mortgage rates to continue to rise. And that's going to lead to less purchasing power for homebuyers and prices declining. But again, this is not so much of a video to tell you that, look, you got to prepare for home prices going down. And I don't necessarily think for most people it makes sense to just bail out of real estate because it's very expensive to bail out of real estate. You're probably going to be paying roughly 10% to sell your home. Now that sounds insane, but especially coming from someone who's a real estate broker who always wants to tell you can sell your home for as little as like 2.5% or 1% with the discount brokers or whatever. But the reality is you've got to pay one agent usually 2.5%, one agent 2.5%, that's 5%. Escrow and title fees, usually another 1.25%. Now you're at 6.25%. And then you want to set aside a buffer for the fact that you're moving, or there's going to be a vacancy period, or the buyers are going to ask for credits and repairs, and they can usually get it, especially in this kind of market, because, you know, once you have a buyer on the hook, you got to be grateful you got a buyer on the hook in this market. So I usually say, look, set aside 7 to 10%. Okay, when you go to sell home, that's expensive. That already guarantees a 7 to 10% loss. Just in selling costs, right? And the housing market's only gone down 5.5% so far. Sure, it's potentially going to go down more, but then you potentially even face taxes if you were to sell. Now, if it's your home, maybe you won't because you've got that $250K homeowner's exemption if you're single or $500K if you're married. But look, one of the best things you can do, in my opinion, is just hodl real estate. And this isn't financial advice, of course, but in my opinion, it's good real estate advice. And I am a real estate broker. I'm also getting licensed as a financial advisor. But again, this is not a financial advice video. One of the best things, in my opinion, you could do is hodl real estate, hold it forever, and then give your kids a stepped up tax basis and never pay taxes. And if you have to sell, 1031 exchange. But I don't think you really want to be a buyer right now. Like if you want to buy real estate, you probably ought to wait until later in 2023 or 2024 when we start hitting more of a trough. We actually start seeing rates coming down and inventory coming down. Okay, now all of that big preface aside, what are the three important things that, in my opinion, every homeowner should be thinking about doing right now, or anybody interested in real estate should be focused on right now? Well, the very first thing, in my opinion, is if you haven't yet done it, it might make sense to refinance, especially if you have a lot of equity that you can tap in your home. Now, a lot of folks are like, Kevin, why would I refinance? I have a very, very low interest rate. And this depends. Let me give you a few examples. So, first example, let's say you have a $400,000 home loan and your property is worth $600,000. In this case, if you wanted to take out up to 80% debt, you could take out up to $480,000 of debt. And let's say your current $400,000 has a low interest rate, 2.5%. Well, it doesn't make sense, in my opinion. It does not make sense, in my opinion, to take the entire $400,000 loan and replace it with a $480,000 loan, because now your interest rate will go from 2.5% to 6.5% or 7%, and that's insane. That doesn't make any sense at all, in my opinion. In this example, I think it would make a lot more sense to use a home equity line of credit. And this is the second thing that you can do, where with a home equity line of credit, you could potentially go up to 90% debt on this property. And remember, anytime we talk about taking on more debt going into a recession, you better make sure you have ample savings, you have the ability to repay this debt, and if you lose your job, you have contingency plans. So only ever take out more debt if you can actually afford these payments. But let's now say you have a $400,000 loan, your property's worth $600,000. If you could get a home equity line of credit from a local credit union, call them up. Ask them, hey, are you doing 90% HELOCs, right? That's what we call them, HELOCs in the industry. If you can get up to 90%, that means you could get up to a $540,000 of debt on that $600,000 property. But since you already have $400K of debt, you're gonna be able to potentially take out $140,000 on a home equity line of credit. Now that's pretty awesome, because that $140,000 would enable you to potentially go buy a rental property when there's real pain in the market and prices have come down, or enable you to go shop for stocks. But again, you only want to take out debt on real estate to shop for stocks or other real estate if you can afford the payment. You got to be very, very careful about that. But it is a nice piggy bank to break. So, for example, at the beginning of this year, I had multiple properties that I wanted to refinance, and I refinanced them in February, so around February 1st. I was able to get like a 4.25% rate, which wasn't even that great compared to what they were back in December. But I took that because I thought rates were going to go a lot higher, and sure enough, they did. They're like 6.5% or 7% now. Now, I realize, even though I've been pitching, do that, since February, like refinance because comps are high, a lot of people hadn't done that yet. And so now we're actually seeing more people refinance, and we're seeing more people refinance at actually higher interest rates than what they had previously. In fact, I have this particular chart right here that shows you that the number of people refinancing who are getting higher rates is actually in the neighborhood of about 80% right now. So it means about 80% of people refinancing are taking a higher interest rate. Now, in my opinion, for most people, you generally don't want to move to a higher interest rate by refinancing. You're probably better off doing a home equity line of credit. And this would be true if your property's paid off or not. Now, on the flip side, if let's say you have a mortgage that right now is still at 4.5% or 5%, maybe it's an older mortgage and you've actually got a lot of equity. Well, if you've got a lot of equity and you've got an older mortgage from maybe the last 5 to 10 years ago, yeah, the downside of refinancing is you're going to reset that amortization table. You're going to be paying a higher share of interest than principal, but it could potentially make sense to just refinance your entire equity portfolio in your property into a new 30-year fixed rate mortgage. So that way you're not dealing with the crazy downsides of a HELOC. Now I'll talk about those in a moment, but if you're going from like a 5% to a 6.5% and you're getting a whole new 30-year fixed rate loan, you can afford the payment, it could make sense to give you the cash to prepare on the sidelines for taking advantage of opportunities that exist in the market now. Now, what are the downsides of a home equity line of credit compared to a 30-year fixed rate mortgage? And would you potentially consider an adjustable rate mortgage? So here's my take on all of these issues. First, what do I consider the downsides of HELOCs? Well, the downsides of a HELOC are that, first of all, you are locking in a 10-year period where you can kind of use the home equity line of credit as a credit card, but that means you're subject to variable interest rates during that time. So when you pull out money, you're paying variable interest rates, and as interest rates rise, you're going to be paying more money for that HELOC as you use that credit. Now, one of the benefits to offset this is if you open up a home equity line of credit and you don't actually spend any money on that home equity line of credit, like you haven't swiped the credit card yet, so to speak, you don't pay any interest. Compared to a cash out refinance where if you take the money and you take the cash and you just sit on it, you're automatically paying interest because you've already taken the money out. Home equity line of credit, you get that flexibility, but when you use it, you're gonna be stuck with a variable rate. And so if rates go up to say 7 or 8%, you're gonna be paying that higher rate. Now, the other downside is you're only paying interest for the next 10 years, so your ability to repay a credit line is kind of skewed because you're only paying interest for the next 10 years until that credit line usually rolls off, and every credit line could have a little different terms, so make sure you're familiar with these. But If you get to the end of that 10 years, now all of a sudden, you're going to have whatever balance is outstanding on your HELOC amortize over 20 years. So you get a shorter amortization period. Now you're paying principal and interest back at the end of those 10 years, and that can hit you with a little bit of a payment shock. Whereas if you have a 30-year fixed rate full refinance you're doing now, you know, okay, this is gonna be my payment for the next 30 years, and it ain't changing, right? And it encompasses the higher interest rate, and it encompasses all of the extra debt you're taking out, so it's a little bit safer. Now, the goal of you doing a full-on 30-year refinance now would be that it may be in 4 or 5 years, you could refinance to a lower rate. If you plan on refinancing after refinancing, make sure, in my opinion, you do not pay points. Paying points for a loan generally only makes sense if you're going to keep the loan for the next 15 years. And in my opinion, the reality is there's not gonna be anybody who's going to keep their loan that they're getting today for 15 years. They're going to refinance this stuff. Keep in mind, you could also refinance a HELOC with either a new HELOC or a new 30-year fixed rate. Now, what about an ARM? Should you get an adjustable rate mortgage these days? So this is an interesting one for me. So if I do mortgage rates, or we just type in mortgage rates into Google right now, I kind of like tracking these, but just make sure you always change it to about a 740 credit score. You can adjust it to what your credit score is, but generally I like to adjust this to the 740 because that's generally considered the best interest rate where you're gonna get, or the best credit score where you're gonna get the best rates. And so a lot of folks are like, hey, should I get an adjustable rate mortgage? In my opinion, the benefit of this like 0.5% here adjustment for, an ARM isn't really worth it. I'd rather just get the 30-year fixed and then hope to refinance in the future. So I'm not the biggest fan of ARMs, especially since we do expect that interest rates, at least for the next couple of years, probably gonna be regularly adjusting up. And when rates do fall, I'd rather just refinance and take large credit backs on a 30-year mortgage than deal with an ARM. It's a lot simpler. It's a lot less complicated. That's just my POV. But if you take the ARM, I'm not going to be offended here. I do think, though, there's an opportunity now to take advantage of a refinance or a HELOC because comps are higher right now, and they might not be for longer. Let me quickly explain what that means. So when the real estate market goes through a business cycle and it falls, then you actually have this beautiful opportunity of potentially, say we're right here, of refinancing based on valuations over the last 6 months, which are expected to be higher. So you're probably gonna get a higher refinance appraisal than you would if we waited longer because prices will fall and then those 3 to 6 months comps will actually push your valuation down, right? So you have this potential of sort of maximizing your refinance opportunity now, which may not last forever. Keep in mind, if you have any questions about like the mechanics of real estate or building wealth through real estate, I have programs on real estate. They're the 0 to Millionaire Real Estate Investing course and the Do-It-Yourself Property Management course. There's a coupon code for those expiring on Friday. You get the best price. You get me in the live streams. We do deal analysis together. Lots of endless information in the lectures where you get my entire brain on real estate in these lectures. So some great opportunities for you. Now, the last and most important thing that I think everybody should be focused on in this sort of market is paying down debt. Whether you own a home or not, you want to pay down debt, especially any kind of credit card debt, car debt, anything that would reduce what's known as your debt to income ratio. And there's a really, really important metric here that is critical for getting you set up to buy real estate in the future. And it's 2, 3, 4 equals 1. Remember that, folks. 2, 3, 4 equals 1. For every $1 of a monthly payment you have on a student loan, a car loan, or a credit card, you have to earn $2.34 more at your job to be able to qualify for the same property value. So for example, if you want to go buy a $400,000 house, and to make math easy, let's say it's a $400,000 loan. So you want to qualify for a $400,000 loan. If you add $1 of debt per month, in order for you to still qualify for that $400,000 loan, you would have to make an additional $2.34 at your job. So $1 of debt is really damaging when it comes to buying real estate, and I think that's a critically important thing to keep in mind. So this is sort of my advice to homeowners right now in the real estate market. Again, I don't know that it is necessarily time to like jump ship, especially, you know, like where are you gonna go? But what if you're a rental property owner? Like, is it time to sell? You know, we've already seen some of the softness come into the market, so I think the same calculus that we did at the beginning of the video applies to rental property owners now. I think the best thing you can do is really just break the piggy bank right now and try to hoard as much cash as you can to prepare to buy more in the future. That's obviously what I will be doing at scale with my company, House Hack. It's a real estate startup. If you're an accredited investor, we're now inviting accredited investors to invest with us at founder share valuations, which is amazing. It's 1-to-1, really ideal valuation. It's the best valuation you could ask for, in my opinion. And read the prospectus. You know, this video can't be a solicitation, so read the prospectus there. And in the future, we might open the door to non-accredited investors with like a minimum of 10 to 15K. Right now, the minimum is 25K. Thank you so much, and we'll see you in the next one. Goodbye.